So what are realized capital gains versus unrealized capital gains? And what are the tax implications and strategies to pay less tax, obviously? So realized capital gain is profits generated from the sale or disposal of an asset where the price is higher than its purchase price. You've made a profit on your sale. And once this happens, it triggers a CGT event and you have to pay capital gains tax on that gain. With an unrealized capital gain, it represents an increase in the value of the asset, but it hasn't been sold yet or disposed of. So, for example, if you purchased a property for X amount of dollars and you know based on particular reports that it's actually increased in value, which is awesome, until you actually sell the asset, then you won't have to pay any tax on it. So the key differences between unrealized and realized capital gains is actually that sale of the assets. Whilst with the unrealized gain, it's basically just a paper profit at this point in time. And just know, again, that realized gains trigger immediate tax obligations. So now that we know the key difference that the realized gains will trigger this tax obligation, then tax planning is really important in helping strategize and manage that capital gains tax so that we can reduce it. So there's certain strategies that we can implement to reduce or manage that capital gains tax, and that includes the timing of the disposal of the asset. So perhaps you want to target it in a particular financial year. So if you held a property in your personal name, you may want to dispose it in a year where you stopped working, for example, and hence reduce the overall tax that you'll pay on that gain. You may want to consider the holding period. So,
just to interject there, just for our listeners. So with the disposal, it also goes based on contract date. So contract date is the day that the contract's entered into. So for example, if you're selling an investment property, it's the day for CGT purposes, it's the day the contract was entered into, not when the actual settlement happens. The settlement usually happens 4, 6, or 8 weeks later. However, for capital gains purposes, it's the day that's written on the contract. So be very mindful of that one. I almost got caught out by it. So just to let our listeners know to keep an eye out for that one.
yeah, definitely. So you need to be aware of the nuances as to what actually constitutes that capital gains event. What date is it? Is it the contract date, settlement date, or is it the contract date in this example for the property? So the next one is a holding period. So if you hold assets for a particular period, so with a CGT discount, if you hold the investment for greater than 1 year, then your assessable capital gains is reduced in half. So if you're nearing that 1 year mark, it might be in your best interest to hold it for that 1 year period so you can access that discount. And then lastly is tax loss harvesting. So utilizing other capital losses. So it's really important that if you've had capital losses in the past, that you keep track of them within your tax returns so that you can utilize them when you do run into a capital gains event. You may also want to realize any capital gain losses that are currently on your balance sheet. Perhaps you invested in crypto and currently sitting at a big loss. Maybe you want to realize those capital losses now at the same time that you realize a capital gain, say on your property, to help reduce the overall tax liability there as well.
And also, so capital losses as well. In Australia, they're basically sitting with you for until you use them. So they basically don't have an expiry date. So you can have a capital loss, say, in year 2022, and then use that in year 2030 when you have a capital gain. So you basically don't lose that benefit of that loss.
Mm-hmm. Yeah. And it applies for any asset type as well. So in that example where I said that crypto or shares losses could be used to offset gains in property as well. So that's a very important thing to be aware of as well, that you can use different asset classes to offset each other as well. Cool. So if you are about to, say, sell a property and you want a more detailed assessment of what the CGT implications are, feel free to reach out to the FTC team. Thanks.